54 million Americans have been in credit card debt for at least a year, according to a new study by Bankrate.
Usually, kind of on the front lines, but so many people have fixed mortgages and very few have been purchasers during this high rate environment. Where, if anywhere, do you see higher rates starting to bite consumers?
American banks are sounding the alarm, foretelling a looming credit crisis that would be even worse than the one in 2008. Further adding to the challenge, credit card companies are now tightening their lending rules, making it tougher for people to borrow money. In fact, a whopping 77% of households are currently grappling with heightened financial anxiety and insecurity. American workers are financially exhausted, and experts are foreseeing calamities striking the economy in the coming months. Let's explore the details to understand why these financial concerns are capturing the spotlight. The financial situation of Americans has done a 180-degree turn in the last couple of years, as we went from having one of the highest personal savings rates in 2021 to one of the lowest on record. Furthermore, credit card debt is at an all-time high, climbing nearly 19% in 2022 to 2023, which has caused the majority of Americans to exhaust their savings and find themselves struggling to cover the sky-high cost of living. For instance, as of August, 60% of adults say they're living paycheck to paycheck, with meager savings and no safety net to fall on in case of emergency. On top of that, the Schlesinger Group indicates that as interest rates keep going up, it is going to become increasingly difficult to get control of debt. Each day, the situation worsens, with millions of seniors forced to postpone retirement because of insufficient savings, and middle-class workers struggling to cover the cost of their children's education. Despite credit cards offering a convenient way to delay payments, they come with one of the highest costs for borrowing money. Presently, the annual percentage rates have reached an all-time peak at approximately 24.25%. Experts estimate that this will result in credit card users incurring an additional $3.4 billion in interest charges over the upcoming year. Over the past quarter, the total national credit card debt has seen a decline of $43 billion, marking the second largest reduction ever recorded. It was further revealed by the New York Federal Reserve that the average household carries a credit card debt of $10,170. However, due to these extremely high interest rates, people end up accumulating more debt when they roll over to the next month, which has severe long-term consequences for them. To give you the big picture, Americans collectively owe over a historically high $1 trillion in credit card debt. Moreover, credit card companies have recently been reporting significant losses due to an increase in delinquencies among borrowers, who are facing challenges in paying off their balances in full each month. With an increasing number of banks imposing stricter lending standards, many consumers are facing increased financial instability. This particularly affects those who rely on overdrafts to cover unexpected expenses and short-term financial needs, all while trying to maintain their purchasing power. Nevertheless, this financial adaptability carries a significant weight, affecting not just those with lower incomes, but also almost 70% of those earning more substantial incomes, who often spend more than what they have in their accounts, resulting in additional fees. Goldman Sachs recently reported that credit card companies are grappling with financial losses due to missed payments and defaults. In the past 3 months alone, these losses surged to 3.64%. Analysts at the bank predict that they will rise by another 1.3 percentage points to 4.93% in October 2023. Losses have been increasing rapidly since early 2022 at a pace not seen since the 2008 financial crisis. According to Ryan Nash, an analyst at Goldman Sachs, the wave of missed payments has only just begun and is to continue into the middle of next year, peaking in late 2024 or early 2025 for most card issuers. This situation has also hit the young generation hard. The uncertain job market has been keeping them from achieving the milestone of independence, moving out of their parents' homes and living on their own. In fact, nearly half of all young adults today are choosing to live with their families. This is because they are dealing with low incomes, paying off student loans, and struggling with their limited purchasing power. According to many sources, in 2023, a significant 45% of Americans aged 18 to 29 are living with their families, a rate similar to that of the 1940s when the United States economy was in a state of complete disarray. One of the main reasons behind this trend is the incredibly high costs of housing and rent. In most places, if one spends over 30% of their income on rent, it's considered a significant financial burden. Shockingly, about half of all renters in the United States of America fall into this category, as the typical rent for a month reaches an astonishing $2,052. To put it in perspective, the average renter needs to earn $6,840 each month after taxes to avoid being overwhelmed by rent expenses. At the same time, the majority of Americans find homeownership to be completely out of reach. A recent report from a real estate data provider who analyzed median home prices in 575 United States counties over the past year discovered that home prices in 99% of those areas are simply too high for the average earner to afford. Adding insult to injury is the fact that the 30-year mortgage rates just reached a whopping 7.4%. In simpler terms, someone looking to buy a $400,000 home would need an annual income exceeding $125,000 to qualify for a loan. Between 2019 and 2023, the price of a typical United States home went from $313,000 to $416,000, marking a significant $103,000 increase in just 4 years. This means that the usual American home now costs a staggering 530% of the average yearly income. As a result, struggling banks are now on high alert. Concerns about a full-blown credit crisis and the subsequent adverse effects on households, businesses, and the American economy have reached unprecedented levels. During a credit crisis, obtaining loans becomes more challenging, and banks that do offer loans often impose stricter terms, such as exceptionally high interest rates or other limitations, which makes financing overall more costly. Consequently, it becomes tougher for consumers to make significant purchases like cars or land, pay for home improvements, or cover vehicle repairs. Retail businesses also suffer as they have limited access to credit, making it difficult to hire new employees, expand their operations, or open new stores. Retailers are already facing issues regarding loans and interest rates. Macy's, the United States' biggest department store, recently reported its quarterly results, which painted a grim picture as their comps were down 8.7%, while income was nearly halved. The signals from the store indicate that more credit-related problems are visible on the horizon. Michael Hirschfield, the founder and CEO of Accrue Savings, noted that retailers are sending the message to the market that consumers are experiencing financial distress. Co-branded store credit cards typically serve as early indicators of financial difficulties faced by a segment of the American population grappling with debt management. The reduction in lending activity by banks is set to have broader implications for the overall economy, exacerbating the economic downturn. Mark Zandi, chief economist at Moody's Analytics, foreshadows a significant tightening of credit in the short term, particularly among small and mid-sized banks. In the meantime, financial institutions are proactively preparing for a period of instability. They're strengthening their cash reserves to prevent experiencing a fate similar to that of Silicon Valley Bank. Typically, banks don't retain all customer deposits on hand. Instead, they bring in profits by investing a portion of these funds or by extending loans and earning interest payments. One of the primary issues faced by the Silicon Valley Bank was their substantial investment in long-term United States Treasury bonds. The institution tied up billions of dollars in these bonds, which depreciated in value as the Federal Reserve aggressively raised interest rates last year. Experts note that banks of all sizes are currently prioritizing the strengthening of their financial positions to withstand impending scenarios, such as a bank run. Consequently, they are tightening their lending practices at a time when most Americans are in dire need of financial support. The Federal Reserve Bank said in its twice-yearly financial stability report that despite decisive actions by regulators to tackle the recent regional bank crisis, worries about the economic outlook, credit quality, and funding liquidity would lead banks and other financial institutions to further contract the supply of credit to the economy. Given the political dysfunction, it is no surprise that Americans are headed towards bankruptcy. A full-scale government shutdown was narrowly averted as President Biden signed the temporary funding bill into law just minutes before the Saturday to Sunday midnight deadline, ensuring government funding until November 17th. A shutdown happens when Congress fails to pass funding legislation that is signed into law by the President, which was the case here, as lawmakers could not reach an agreement until right before the deadline. Bloomberg warns of the severe issues stemming from the ongoing challenges in the administration's monetary management. In a shocking revelation, it was shown that the United States government is presently allocating more funds to service the interest on its massive $33 trillion national debt than it is directing towards a national defense, as per official figures. In the current fiscal year, the Treasury has disbursed a staggering $807.84 billion in interest payments on its debt securities. In contrast, the Department of Defense has allocated $695.44 billion for its programs during the same period. This mismanagement for the administration is having dire consequences on the average citizen's wallet. This affordability crisis is unlike anything we've seen before, and it's affecting prices across the entire economy. Just recently, a study pointed out that the average American family is getting closer to a critical point where people cannot withstand their credit card debt any further. Compared to a year ago, there has been an 18% increase in the number of personal bankruptcies. As a result, people find themselves increasingly reliant on credit cards to cover their daily expenses, a departure from the past when they were mainly used for significant purchases. Nowadays, people are turning to credit cards to meet essential needs like rent, energy, and groceries. As of September 2023, the federal debt stood at 120% of GDP. This clearly shows that the government has lost the financial capacity to appropriately respond to a crisis, which has set off sirens in expert circles. Therefore, if more individuals default on their debt and more financial institutions face failure, our economy will be left vulnerable without any form of safety net to prevent collapse. In conclusion, the current financial landscape in the United States is undeniably fraught with challenges that are affecting both individuals and institutions. As America's looming debt crisis continues to expand, the risks escalate for each and every individual. The consequences of the government's failure to take action to avert this impending catastrophe will only worsen at this point. The urgency of the situation cannot be overstated, and decisive action is required because time is running out. Comment down below on what you think, and leave a like if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.